Nearly there. Hello, good evening. Sure, we're coming towards the end of the semester, end of the module. Everyone's getting a little bit tired, possibly a bit anxious, but I think we're going to like what I'm going to do tonight from Learning Unit 8, and it is the last of the units. So I have uploaded resources today. So the overview is there, some notes are there, and also some questions. Right, so I'm going to share something with you. In fact, two things. This one first. Right, so what is Learning Unit 8? It's all about a big organization that has multiple divisions, and each division has somebody in charge, and that manager has to have their performance evaluated. So based on how the division that they are in charge of is doing, um, we can do various calculations and we can pick which is a better performing division, etc. So there is some theory at the beginning of the learning unit. It's just the pros and cons about being a centralized business where it's a top-down management structure, or if it is decentralized. If it's decentralized, then the managers at the different levels have autonomy to make decisions. So we're going to take that perspective and we're going to say, how could you possibly evaluate their performance? And there's 4 criteria. One is return on capital employed. Another one is return on investment and residual income. Those are the ones we're going to be having a look at. So how are we going to get your return on capital employed? It's basically a profit of some kind, because that's the return, based on the funding that went in to generate the profit. So this version of the return is earnings before interest and tax, and we're going to relate that to your capital employed. And what we mean by that, it goes under various names. It could be capital employed, it could be invested capital, or net assets. Net assets is all of your assets, subtract only the current liabilities, not the non-current. So you could be given some information, balance sheet items, and then you would have to work out what the net assets are. I think you'll find that really easy. It's basic finance and also basic accounting. Then for return on investment, it's still your capital employed or your invested capital. However, the numerator is different. This time it's your net profit after tax. And something that is important here with the profit is that it must be adjusted for any deduction that was made by head office. So let's just think how we get our profit. It's the income, and then we start to minus the expenses. So variable cost, and then with the fixed costs or the overheads. Some of them we learned in Finance 2A belong to a division or a project. So those are the attributable variable cost. Then, the fixed cost. And then the others are your general overheads. And they need to be allocated amongst the divisions based on more or less an arbitrary allocation that head office decides. So because the manager of the division has no say in that, you can't hold them responsible for that. That's why you have to take a head office cost allocation that was subtracted to get the profit and add it back on. Then to get residual income, residual means what's left after something has come off, the leftover. So once we subtract the interest on the capital from net profit, that's called residual income. So we need to obviously find how much that capital is, so we can then calculate the interest on it by using the division's cost of capital. So in a way, it's a little bit like accounting, where you have to work out concepts like your net assets and your profits. So a lot of it is centered around depreciation. The reason for this is because it's one of the costs that get deducted from your income in order to arrive at your profit. And it's quite considerable, the amount. It's lots. So we need to just remember there's more than one way to deal with depreciation. In fact, you learn quite a lot of these in your accounting. So there is the straight line method, very easy, where you take off the same amount every single year. And how do you do that? You take the price you paid for it, or the cost of the investment. If it has a residual value or a scrap value, you would subtract that, and you would divide by the number of years in the useful life. And that, as I said, would give you the same amount every year. And then you fully depreciate it over the lifespan till the asset is worth nothing. However, the annuity method, there's quite a lot more going on there. So tonight, I want to look at this. You obviously will not be able to calculate the amount, the annual payment, because you would either have to do it on a, oh, here's somebody coming in. Let's just admit them. David. You'd either have to use a financial calculator or otherwise Excel, which you can't do in the exam. So that's why we say that payment will be given. And it will be set out in a table. And it's the same as something I think you've done in accounting. That is an amortization table. There's lots of columns happening in there. So how are you going to do the depreciation? I'll show you in a few minutes, but the column in this table, whose heading is capital repayment, that's what you're going to use for depreciation. So when you've done your calculations, you might be asked to pick the better performing division, or to say if a project or an investment should be accepted, yes or no. So here are the criteria. So if you're doing any of the return ones, for example, return on capital employed or return on investment, what you're going to have to do is carefully read the info in the question and then look at the targeted or the minimum required percentage. Then if the one that we calculate is bigger than that, then we say we will accept it. If it's not, obviously, reject it. Now, for your residual income, remember what we did. We subtracted the interest from the profit. And if we land up with a positive number, that tells us that there's more income than the interest. So it's going to be positive. In other words, profitable. So that's why you will accept it. If you have a negative residual income, it means that the cost of the capital exceeds the return on the capital. So loss making, therefore reject. So there are some questions you can do in the book. They're there in the turquoise. And some of my revision exercises. We are going to do one tonight, so we can also pop in here number 1. That's the one I'm going to do tonight. You can practice some others. And then just a bit of a heads up in the book. There's quite a lot happening there that is a bit out of scope. That will be something you do in Finance 3 next year. So anything that mentions net present values, you can give that a miss. And SARS deductions, that's not prescribed for this particular module. So what I want to do tonight is a question that entails the annuity depreciation method, and we're going to work out return on capital employed as well as residual income. Right, so let's do that. It's going to be one of my questions here that I've taken the liberty of doing the answer ahead of time to just save typing time. So here's a story, and let's see what it asks. Go down here. It says, calculate the impact of accepting the contract with a customer on what? Return on capital employed, and secondly, residual income. So those are the two indicators that we're going to work out tonight. And then when we've done that, we need to make a recommendation. Accept it, yes or no. So what is this contract that we're talking about? Let's have a little look at the question. So we have Alpha Division, which is part of a bigger group, and we need to evaluate the performance of this particular division. So an opportunity has come their way. So they have been expanding, and now there's going to be a new client here. Let me just highlight the main parts of it. New clients, they are willing to sign a 5-year contract. That's what the question's on. And in terms of that contract, the Alpha Division is going to have new annual sales of $1 million per year. And obviously that will be over the 5 years. However, they're going to have to expand in order to fulfill the contract. So let's have a look at some of that information. There's a total capital outlay of that, $1,275,000. That is for new machinery. The machine is obviously going to have a useful life of 5 years because that's going to match the duration of the contract. Then we have some other information in here. Let's just highlight a few things. Operating costs, so much a year, $450,000. And notably, that excludes depreciation. That's very important, meaning we have to work that out. And over and above the machinery capital that we're going to need, there is also $225,000 for working capital. So there's a lot happening over here. So let's see how we're going to start. In order to get the return on capital employed, we need a profit of some kind because that's the return. Most importantly, we need the capital employed. You will be given the format and the tables in the exam. So don't stress out too much over that. You just need to know how to work out the various elements and then how to put it all together. So the first thing we're going to do is we're going to try and deal with this depreciation because that will be one of your costs to subtract together with your operating cost. So it is the annuity method. And as I said, the annuity amount will always be given. You can't work that out. So let's just get what that amount is. Here. There we go in the bright yellow. 389,397. So this here is the amortization table that will be given. You'll get these headings. So what we're going to do. First thing I must jump up and down and scream and shout and make sure nobody makes a mistake here. Because you can understand that if you start going wrong here, oh, it's going to get very ugly if you make a mistake there. So the only thing that is subject to depreciation is the machine, not the working capital. So you mustn't include the capital outlay of the machine and add in the 225,000. That would be a bad mistake. So you see, it's just at the beginning of the period, it's that 1,275,000 for the machine. Now we have to start depreciating that. So it's going to be fully depreciated over the 5 years. So what we're going to do straight away is deal with this. Yeah, that annual repayment is given. That same amount over the 5 years. So you would write that in first. Now that amount that you pay can be split into two. Part of it is the interest, and the other part is the redemption of the capital. So the first thing we have to do in the split is this. We would do this first. We would find out the interest on the capital, which means we have to go check out what the interest rate is, and that's up here. Division's cost of capital is 16% before tax. So now all we got to do is come and find 16%. So let's just type it in there. So we know what we're doing. So where am I going to get this first number from over here? 16% of the 1,275,000 gives me 204. Then I must subtract that from my annual repayment. The difference is the 185, and that is the capital repayment portion. It's quite easy. So all we do every year is we take the total annual repayment, we find the interest element, subtract that, and we get left with the capital redemption. Now, that's the amount by which the capital is going to reduce. So this amount over here, we're going to subtract it there. We're going to minus that, and it's going to give us that. Then in year 2, we start over. This time, we're still making that same annual repayment, but we're going to find the 16% of the 1,089,603. That gives me 174, which I subtract from the 389, gives me 215. Then my capital outstanding will now, at the end of year 2, be 215,000 less. So that gets us to 874. You see how the capital outstanding is decreasing. Year 3, we make another repayment. Find your 16%. First of all, gives me the 139. Subtract it from the 389, gives me 249, which I subtract from the previous capital outstanding, gives me the final capital outstanding at the end of year 3 of the 625. And so on. Every single year, we then go and take the annual repayment, find the interest portion by using the interest rate, which is the cost of capital, on the capital outstanding at the beginning of that period. Then that capital repayment you subtract, and you'll get your closing capital outstanding at the end of year 4, and so on and so on, so that at the end of year 5, give or take maybe 1 or 2 or maximum 5 rand, depending on the rounding, you get left with nothing. It will always come down to 0 or some number that is less than 10 Rand. So that's step one, finding your depreciation. And that depreciation, I think we just need to make that a little bit more obvious. There. We're going to refer now to these numbers quite a lot. Next thing, we're going to come here. This is step number 2. I just wanted to get it all on the one page. So let's do this first of all. You do that, sort out your depreciation. Then you can't fill in that table unless you know this. So we're going to have a column for each year. And we're going to find the most important thing down at the bottom. This is what I'm aiming for. I want the opening capital employed at the beginning of each year. So how are we going to do that? Starting over here with a value of the machinery at the start of the first year when it's brand new. Then those depreciation values from here, there, the ones we have just worked out, we are going to put them in here. And then every year, we're going to subtract the depreciation from the opening value. That will then give me the closing value, but only of the machinery. But remember, the machinery is not the only element of the capital employed. What we need to then go and do is we must add the working capital, and that we said was 225,000 each year. So when we do that, we're going to get total capital employed at the end of each of the years. So I will give you the answer to this, but I think it's quite straightforward. So now what do we need to do? Step 3, we need to tackle this. So we're trying to work out return on capital employed. Just a reminder on the two things. The return on capital employed is what we want. One of the other things that we want is residual income, but we're still quite far from getting that. So what we're going to do is find profit. So we need to have a look at sales. Let's refer back to the question. Where was that? Over here. It says 5 years, sales, 1 million. So we're going to put that in our table over here. Now we start to subtract the various costs. First up, we're going to be dealing with these operating costs of the 450,000. Same every year. Then, importantly here, depreciation. Different every year. Where those values coming from? Here in the table. So it's all worked out already. Then we're going to subtract, and we're going to get your annual net profit. And this is important, the annual net profit. Trying to get the yellow here. And what do you notice about it? Every year, it's different. So can we do anything yet? We can. We can work out return on capital employed, because we're going to take the profit and we're going to divide it by the capital employed each year. So possibly let me just write that in there for you. How are we going to get residual income? Let's just abbreviate annual net profit divided by capital employed as a percentage. Oh, no, I've written it in the wrong place. Let's spin it. And it was also, sorry, slightly too big. Let's do that. Annual net profit divided by your total capital employed times 100. So where are our numbers coming from? Let me just show you how we got this 24.31%. And this is what I do suggest here, very much so. Here, let us round to 2 decimals with the percentages. So first of all, we're needing to take our annual net profit here of the 364,603. And how am I going to get my return? I'm going to, oh yes, here they are, sorry. I forgot that I did it down here. Let's rather have a look over here. So there is my annual net profit of the 364. And here is my opening capital employed in that first year. That's where we get 24.31%. Let's try year 3, just for argument's sake. In year 3, my annual net profit here out of the table, 300, 530. What is my capital employed? That number. So here is how I get my 27.33%. And you would do same for all of the years. So that's not difficult, I don't think. And because you're given the tables, you are guided as to what to do. I think this is a fabulous way to get yourself 40 or 45 marks. So we've now done return on capital employed. We are now left with residual income. So we've got the profit, but what we now need to do is subtract the interest on the capital that was used. So that's what the meaning of this term here is. Imputed interest just means calculated interest. And how are we going to do that? So we need the capital employed. Again, that's why this is such an important table, because that's where your capital employed numbers come from. And you have borrowed all of the capital. So that's why the cost must be based on total capital employed, not just for the machinery and not just the working capital, all of it. So what we're going to do is go find the interest rate again up here. There, this 16%. I also just want to point out here before everybody starts making some silly mistakes. Here, read the interest, well, read the, what should we call them? Percentages very carefully. I have so many campus students that make such a dreadful mess of this. And if they do, then the whole depreciation table is wrong. Everything is wrong. So we have got here 16%. That's the cost of capital. But what is this other thing over here? Let's see what color we could highlight in. Running out of options, really. 22%. That is the target return on capital employed. When are we going to use that? Once we've worked out our capital employed in each of the 5 years, as we come to say whether we should accept the contract or not, we need to compare it with that 22%. That 22% is not the amount that you use for interest. Cost of capital, that is the percent for interest. So we are going with the 16%. So let's come down here. I have my workings. Yeah, this step over here. So this would be after we've done this table to get the ROCE, we are then going to do this, working out the interest. So we see here it's 16% all the time, of which amounts? These ones, like that. See there. That's why we must do this middle table to get your total capital employed. Those amounts, we then simply come, let's take for year 2, 210,336. There is where we put that in, and we subtract that from the annual net profit, and that will give us residual income. So it's the income that is left after subtracting the interest. So let's maybe type that in there. So residual income is your annual net profit minus the interest. And it's an amount, it's not a percentage, it's an amount. Does anybody spot anything quite spectacular there about the residual income? Take a second just to look at it. What about the value every single year? It
All the
is,
same.
yes, fabulous. It is the same. It must be the same because of the method of calculation. And that is the clue to you that if you don't get it the same in the exam, you've made a mistake. You better go back and make sure it is the same. Right, so now we are in a position to be able to answer the question. Let's see what it was. Should this division accept the contract from the customer or not? So we're working out the return on capital employed and the residual income of the investment or the project. So now is the time where we're going to come up here and we're going to see what return the business actually requires. And that is that 22%. So what values have we got? 24, 25, 27, 30, and even higher. So we can say based on return on capital employed, we should go with the investment because it exceeds the targeted or the minimum required return. So here you can see, let's see if I can maybe highlight this. Oh, I knew that would happen. I still haven't found a way to overcome that. Oh, what did somebody tell me once before? Was it Control Z? I hope I'm not going to. Oh, it works. Yes. Thank you. Was it you, Victor, who told me that last week? I'm not sure.
No, it was Keenan, miss.
Oh, was it? Yes. Oh, and I happen to remember it. Yeah. So anyway, here's the decision. We're not going to try and highlight the thing. So we're going to say, look at this one here. The return on capital employed that we get above exceeds the target return of the 22% in all the years. So on the basis of that, it's a yes. Now let's have a look at the other criteria, which is the residual income. As I did say, it can either be positive or it can be negative. If it's negative, it's no good because it means that the interest expense exceeds the return. So that would be a loss, therefore a no-no. If we have positive residual incomes, it indicates greater return than interest expense, so profitable. And obviously, if you were doing this analysis for more than one division or more than one project, the higher the positive residual income, the better. So because we've got nothing else to compare with, we're only dealing with one, they're all positive. What can we say over here? That your residual income is positive for all of the years. So for both reasons, we are going to accept the contract. So I know a typical question that you are probably going to ask, what happens here if some of the return on capital employed are below the target return? So long as it's not 4 out of 5 of them, depending on how you word it, you could get all of the marks as well. So you could, for example, say, so long as the residual income is positive, and if we have, if the business desires high profit towards the end of the project, in other words, it doesn't need high profits to be earned soon, because if you don't have shareholders jumping up and down or senior management, if it doesn't make too much difference as to when you get the higher profits, then if you have 1 or 2 that are below the target return, you could also recommend yes. But if they are all below, then you would toss it out on the basis of that. Right, so just a reminder that the tables and the column headings will be given. So don't worry about that. So you're going to have to obviously practice a question like this. I will give you another one. There's also one in the book. Let's find that one. Where are we? Over here, it is question. No, not that one. I'm just trying to find it. 8.2. So you can do that. Let's go here. So we're going to do a practice question. It's equal to question 8.2 in the textbook. And I can give you another one. I will also give you a revision exercise 2. And in that one, we're also just going to say here, let's go. Also try the same type of a question, but with a different kind of depreciation. But with the simpler one, the straight line method of the depreciation. So you will do everything the same, except you won't have this table over here. That won't be necessary. Go back to here. Let's see where it is. Yeah. You're going to use this way to work out the depreciation, and it's going to be the same every year. So what would you then do? You'd give this table a miss, but you would come here and you would put that same depreciation in there. It will be the same. Notice these ones are all different. Straight line is same. You will still have to do a table like this using your new same numbers over there. And just something of interest over here. Your sales would be the same. Operating the costs the same. Depreciation with straight line methods same. So your annual net profit every year would be the same. Here with annuity method, it's different. And then you will find that your residual incomes will also be different. So I think you're going to like practicing that question. Try question, what did we say, 8.2 from the textbook. If you want another one with annuity, just give me a shout and I can organize one for you. So the other things in Learning Unit 8, you can try my revision exercises. I have put those up already. So we're going to say, do revision exercises 3 and 4. They deal with slightly different topics in the same learning unit. And I will also put up a new, I didn't do it this afternoon, I forgot for some reason, revision exercise 2. Then I'm happy that we're done with the syllabus, and we're going to use the remaining time and possibly a little bit of extra time if we want it to fine-tune a few things and then get ready for the exam. Right, so that was quite a long session this time, but I think quite a nice topic. Oh, I see, Keenan, you've joined. There we go. Thank you. I didn't see that, but I remembered that Control Z from last week. Oh, you think it's an information overload? Haha. Yeah, because it's quite a lot longer than other questions. But bear in mind the mark allocation, it could be 45. And they're all quite straightforward. There's no tricks. There's no, do I do this or do I do the other? You just have to get yourself sorted. Yes, it is a lot, but if you know how to do it, it's very easy to get full marks. So I'm going to really sell this one big time to everybody. So I'll end the recording here quickly, and then we can just have our usual little weekly chat. And so, end of a very long, information overloaded for a change recording. Hope it makes sense.